Christopher Peel joins us, Chief Investment Officer of Tavistock Wealth. Let's point out Janet Moy is also here with us, global economist at Cazenove Capital. Christopher, good morning to you. I read from your 2020 outlook, we're favourable for risk assets such as equities and commodities and neutral at best for bonds. Can you just walk us through that risk environment you're anticipating then into the early part of next year and why the positivity?
Well, I don't think the story's significantly changed. I mean, clearly the global economy has been slowing for the past 18 months, but the fact that you've had central banks come in and reduce interest rates to try and draw a line under the slowdown gives me the belief that investment will start to increase, and also the wind that's helping this whole process, I suppose, is the trade negotiations, whether versus China or the new NAFTA, which hopefully will be ratified relatively soon. This is going to kickstart, I think, another round or an increase in global trade as we get into 2020 and beyond. And that team with low interest rates, is a good environment to be long equities.
I tell you what, your crystal ball's working a lot better than everybody else's. How come you've got so much clarity on how this trade row is going to be resolved? We still haven't seen ratification of the new NAFTA replacement, the USMCA, and there was some suggestion that because that's bogged down in the politics now, that's why Trump was suggesting we may have to kick the China trade deal into post-election. So you seem to see things differently.
Well, I think the Democrats are now leaning toward supporting the new NAFTA, and it's on the table as we speak. In terms of the China trade, I think it really helps Trump's re-election to have some type of a minimum phase one deal agreed, because it shows that he's been successful in yet another thing on top of the tax cuts.
Janet.
Are you asking about the trade deal?
Oh, I thought you wanted a question to Christopher. No. Sorry, I misunderstood the signals there. Well, let me ask you the question. I think we talked a little bit earlier on about the prospects for a negotiated trade deal at this point. Trump had said previously that this would be kicked into the long grass and we may not get a resolution until after the election. Do we have to run with that prospect in our minds when we think about re-engaging with risk assets at this point, notwithstanding Christopher's ebullience?
In our view, we think that as long as the trade tension doesn't escalate further, I think that's quite a benign environment for risk asset already. And our base case is that the next tranche of tariff on December 15th will not go ahead. And I think markets would be pretty happy about that. I mean, a lot of that is priced in, but there's still a lot of uncertainty around that. So if we don't see further escalation, I think we're in a pretty decent environment for risk asset.
What about some of these other grey rhinos then out there, like the UK election outcome, the prospects for Brexit? He's got a Boris trade on.
Yeah,
well, let's talk about that.
A few people's given us clear. Come on in. What is it?
I have a Boris trade on. I've been underweight UK equities for the last 3 years, and we've now moved to a long position on the premise that the Conservative Party will win a David Cameron-like majority, a small majority at tomorrow's vote. There's obviously no certainty. The polls are very tight, but I think the UK population as a whole wants some finality to the situation, and that's what
the trouble is half of them want to stay in Europe, the other half want to go out. That's the problem.
But it's not a trade without risk, but also sterling. I think the sterling is very, very cheap if one thinks Boris Johnson wins a majority. It's also grossly overvalued if somehow Corbyn finds himself in number 10. But the risk, that's not a 50-50 trade. I think Boris will get over the line.
Okay, I have a couple of questions for you. One very briefly on this one, then we'll move on. If you're right, and the Tories win a working majority where they can push forward with their view of the next couple of years' relationship with the EU, are you up against it on the currency working against your trade? Because obviously the dollar earner story.
That's because if I was long FTSE 100, yes, one could argue that a strong pound will hurt the earnings of the FTSE 100 companies. But I'm playing in the next tier down, the small to mid cap space, which has lagged over the last 3 years. So it's a UK trade from the equity perspective.
Right. Okay, well, I want to give you my other trade a question there, because we're off camera. We've been talking about gold and gold-silver ratios and silver on its own as well. And you implored me when I looked at the silver price, which is trading roughly, what, $14, $15, has been as high in 2011, $60 plus, I think it was. Well, so it's down. And then you told me, no, look at the gold-silver ratio. So I've done exactly that, and I've got a little chart on my screen as well. That's the gold-silver ratio again. What should I be doing in this space? Because be careful whatever you say, because you know what the bugs are like out there. They get very funny when you start talking about gold.
Well, this is the Widowmaker, so tread gently.
Widowmaker.
This is the Widowmaker, the famous silver-gold ratio.
Yeah.
You know, gold has morphed into something other than just an inflation hedge.
Yeah.
The fact that interest rates are as low, the opportunity cost of holding gold is dissipated. So you've got new buyers who are trying to substitute arguably maybe some bond-like risk in gold because the opportunity cost of holding it is zero. So that's really moved the ratio to where it is. Silver has fallen on love. I think there's been overcapacity or overproduction, but certainly there'll be lots of people that remember the Hunt brothers back in the early 80s, and it looks quite attractive.
Yeah, they tried to corner the market. It didn't go quite so well for them, did it?
Oh, so close.
Also close. Okay, let's move on. You're going to stay with us. We'll come back to the conversation. Let's go back to the conversation we're having around strategy and the outlook for 2020. Christopher Peel is with us, Chief Investment Officer at Tavistock Wealth. Janet Moy, Global Economist at Cazenove Capital. Christopher, let me just pick you up on your dollar call here, because there is a big body of cash, I think, looking at the emerging markets and trying to decide whether 2020 could be a better year than we've seen already this year. And it seems to me the swing factor on that is what your call is on the dollar for next year. So what are you looking for?
I'm looking for the interest rate differentials to work against the dollar, which is why I'm looking for a very marginal grind lower. You know, it's not a big call, it's 3 to 5%, but 3 to 5% down in the US dollar on a trade weighted basis helps emerging markets, obviously because interest rates are so low anyway. So I think it's a plus for EM equity and local market debt.
I mean, the States will still enjoy an interest rate lead over the rest of the world, and as it's demonstrated with its recent jobs data, it looks like the strongest market in terms of aggregate demand at a consumer level. Why the justification then for weakness for the dollar from here? Surely they're going to continue just to attract capital from around the world as they look like a better prospect.
Well, I suppose I look at it as maybe the weight of money. You know, you've seen some activity 12 months forward on buying puts on the US equity market. You know, what isn't in the price is a change of leadership, a move to the Democrats and potentially Elizabeth Warren. That could have hugely negative consequences for U.S. equity. So I think global asset allocators who have had a fantastic run in U.S. equities, that rotation is going to start, which is going to chip away at the demand for dollars on a global basis.
Janet.
Yeah, what we think is that if we start to see more green shoots in manufacturing, if there are progress in the trade talks, then actually the more cyclical areas of the economy, such as Eurozone, EM, they should start to benefit. And if that's the case, actually US dollar tends to weaken because I think capital will start to go into these kind of cyclical and more growth areas of the global economy. So what we expect is that if all these play out, what I mean is green shoots coming out, the trade progress is happening, and then we will start to expect some modest depreciation of the US dollar next year.
But is the US stock market perfectly priced for the underlying economic scenario which you two are both looking at for 2020 as well? Because we haven't discussed profitability, and whilst the labour market looks incredibly robust at the moment, and whilst inflation looks incredibly dull at the moment, and the US is growing at a premium to what we're seeing in Europe, I'm just wondering about the profitability of the stock market. And something we haven't really mentioned much this year, but we spent a lot of time over the previous couple of years talking about it, which is the profits recession. It's kind of gone into the ether a little bit this year.
Well, I think I would look at that as what do you want? Where do you want to invest? Buying bonds at levels down here where interest rates, I mean, a good chunk of the global bond market's in negative territory. You still have inflation, although it's low. So you're locking in negative real rates of return in bond land. So to put your money to work in global equities, the opportunity cost is as low as it's arguably ever been. So you're right. There is the earnings growth has slowed, but the alternative investment opportunity doesn't seem to be there.
I mean, does the earnings growth matter? It sounds terrible to say that, doesn't
Yeah,
it,
it
at this
does.
point? But do we need to be more worried about whether the Fed's balance sheet goes from 4 trillion to 4.5 trillion to 5 trillion as a source of continuous liquidity to drive risk asset prices higher at this stage? I mean, if you sat any strategists down at this point last year and said to them, you're going to make 25% on the S&P next year, they would have looked at you like you were an alien.
Plus dividend.
Quite frankly.
Plus dividend, yeah.
Right? So, you know, again, we're having to make that kind of call at this point as we look toward 2020. Isn't the key issue going to be just how easy the Fed is going to continue to be on that balance sheet expansion and the support for the repo market rather than what the earnings profile looks like?
Yeah, and I think my view is the looking at QE, marking it to market, it's only half time. Until the balance sheets go back to where they to zero, you know, until the central banks have sold their holdings or had their holdings mature, the clearing rate for interest rate for new government issuance is, you know, it's a false market. So until QE is unwound, we don't know where the trade stands. At the moment, it's been a good trade.
Excellent. Chris, just want to make sure everything's okay. You're different today. There's something about you, I don't know.
It's the tie from my mother.
It's the tie for your mother, isn't it? And this is just the backstory is you're normally very relaxed, you know, a couple of buttons undone, just kind of flown in from somewhere exotic, but you've got a beautiful tie on today. You're incredibly smart.
Thank you. I can assure you I'm very relaxed.
But it's lovely. Is it Mrs. Peel?
That will be my mother's name, correct.
Mrs. Peel, lovely to have you as a viewer on Scorebox. You can watch the other days when Chris was not on as well. It's amazing how we all...
Great taste, though, don't you think?
I think he looks
Mrs.
fantastic.
Peel
I
has
think putting off the
fantastic
double-breasted is not an easy call either as well. So you do it with aplomb, sir. Have a lovely holiday and the best wishes to Mrs. Peel as well. Christopher Peel, her lovely son, Chief Investment Officer at Tavistock.